All right, all right, all right. We are ready to rock and roll here today. How are you guys this morning? Hopefully you had an enjoyable class last night at the university. And this little thing's giving me a little trouble here. There we go. So hope you guys had a good time last night at the university. We had a good class. It turned out really nice, I think. And very excited to get started with the lab. So what we're going to do today in the lab is we're going to go through and we're going to pull up some of these stocks that we talked about last night. We're going to do a little bit of technical analysis on them. And we're going to see if there's, did you see the markets today? Holy cow. What a flush. What a big flush today. I'm glad I got a hedge on. Did you see Meta? Meta went straight up. Microsoft went straight down. Let's go look at some of these stocks that are in here. Let's come in and let's just pull up a new, portfolio just for fun. Take a look at what's going on. It's a bloodbath today. MSFT. Did you guys see this one? Down that baby went. Look at that. That's terrible. I didn't think it would do that. So we had this, and we had this. And so this is coming back down into the Delta Cone probability, right? And then I think that they probably had some pretty unfavorable earnings. Microsoft and their earnings. All right, so we're going to come in here with the Fibonacci ruler. We'll go from the bottom to the very top, all the way to the top like that. And look at that. There's your Delta Cone probability, and it came right down just like a train on rails and touched that 61.8% number and stopped right there. Crazy, isn't it? So it's right there in the dead center of that Delta Cone probability. So we'll have to wait and see what happens. Come on, chart. No auto scaling. So we got in here, and that's what Microsoft did today. So we're going to wait and see, because this might be an opportunity to buy some Microsoft. Buy low, sell high when there's blood in the street, right? We want to pick up some shares. Look at my Meta is the other one that took off like a rocket ship. Look at that. Now, we bought some Meta right in here. The only the bad thing about that is you just wish you had more. I only bought $10,000 worth and wish I had 50, wish I had 100, right? So this was in the same type of a situation. We had this nice little 3-drive pattern. It's a little double top here. Then you had a drive here and a drive here. And then we started going up. The reason I bought was because we started to go up, right? And we have a higher, this is the low. And then we had a rise, then we had a pullback. The pullback wasn't as high, wasn't as low as this one. So we started going from making lower highs and lower lows to making higher highs and higher lows. Does that make sense? So everybody understands that. And so that was the reason why when it came in here, we had our decision point trading, right? Decision point trading. So decision point came in there, and there's the little blue light coming in. And when it went right from yellow to green, I bought. So I bought $10,000 worth right there. Wish I'd have bought more, but that market took off and went to the moon while Microsoft flushed and went down. I had a little bit of Microsoft, but I didn't lose very much because I only had it in an option. So the option kind of went against me, but that was pennies compared to what we made over here. So since the option went down, I just lost $300 on that one. So I lost $300 in Microsoft, but I made a whole ton in Meta. So I think this is going through the earnings cycle and through the earnings season. So you have to be very careful. That's why we were trading Microsoft with options. I traded this one here with FBY. FBY is the one I bought. I didn't actually buy Meta. I bought FBY, which is the same thing, just a different version of it. So I'm actually in right here. And so this is the one I bought. All right. So that's the kind of the market for today. Let's go look at NVDA. Let's go look at NVDA. NVDA, it dropped a little bit, but not much. I've got some options on this one down in this region here, so I'm still okay on this one. Not too worried about that one. Got some sold puts down in here, so we're okay on this one so far. And then let's go look at Apple, Amazon, AMZN. I got some options on this one too, but they're way down here. So I'm not worried about those. Some sold puts way down here. And that'd be pretty cool if we could Well, you say that, but if that thing came all the way down there, I'd want to buy some shares, right? So we'll see. Right now, we're looking at MAGS, MAGS. So MAGS is the entire market. So this is MAGS. This is the Magnificent Seven. And so Apple, Amazon, Netflix, Google, Tesla, some of the others. So that thing's coming up, and it's looking like, to me, it's starting to go down. This is a blow off top on this. So combined, I think we've been waiting for a blow off top, right? So if this thing comes back down altogether, turn off auto scale. So if this thing comes back altogether, this would be our first target, would be down in here. So February is known as the give back month. So February is coming up here, and it's considered the give back month. So we oftentimes give back a lot of our money that we made in the first part of the year. We give it back in February. And so we got to keep that in mind. So I have a hedge on. For those of you who've been following and watching, I have a hedge on to protect against this downside position. I have YQQQ, and this is my hedging market. So if the market goes down, this fund makes money. Okay. So if the market goes down, this fund makes money. But if the market goes up, this fund loses money. Well, the market's been going up like crazy. So you go look at MAGS, and the market's been going up. So this fund here is going to lose money when that happens, when the market goes up. But when the market goes down, like we're seeing here, like we're getting ready for this to happen, right? We're getting ready for the give back month, getting ready for this thing to come down, MAGS, after all this. Well, this fund will make money, right? It will make money. So I've got $200,000 in this fund right here. And it's a hedge. So the chances of the market continuing to go down, well, it could very well go down, because I mean, this market MAGS could go up, right? And it's not actually MAGS, but for the most part it is. It's QQQ. So if QQQ goes up, see that QQQ, the reason I've got that hedge on is because I've been anticipating this wedge pattern, that we're going to get a little bit of a pullback, and that this market's going to give back in the month of February. And so that's kind of what we've been looking at. And then if we look at the Fibonacci ruler, which we don't want to do, because this market went way up, and I just hope like heck we don't get the kind of blow off that the mathematical models are calling for. I'm going to temper it down here in just a second, but this would be the full delta cone of probability off the entire last run. And that would not be somewhere we want to see this market go. Not that it couldn't, certainly could. The US dollar has been tanking like crazy, right? A lot of countries have been pulling their money out. China's been pulling their money out of the US dollar, been selling off their bonds. Been some other companies have been threatened to do that. Other companies dropping their bonds. But we've also got, this is this first little drive right in here. So if you go from this one, and just from the bottom of this trend here to this one, the next first level we're looking at is right in here. So that's our first level. This is the second level. We don't want to go to second level. So that's kind of where we're looking at for the first run, is just to see this market flush, probably back down into here somewhere. And if it does, well, I've got $200,000 sitting in this market to protect me. So that means this will go up if that actually happens. And so if this goes up, right, then I'll make some money there. But then I'll have $200,000 basically sitting on the sideline, or sitting in my hedge, that I can then take over and start buying in to here. I'll start buying in a little bit here. We'll wait and see what the patterns look like, but we'll start seeing if the market wants to come down in here and then rebound. And if it doesn't, if it looks like it wants to come down and go down another level, then we won't go all in. We'll do the little dollar cost averaging thing, right? A little bit in here, a little bit in there, dollar cost average on the way down. So I've basically taken a whole bunch of money out of the market, $200,000, and put it into the hedge, which is the hedging of the other side. Okay, I still got a bunch of these markets in here, but nonetheless, I'm in a hedge to the downside. So to protect myself against this type of a drop. And Hopefully these other markets are a little bit stronger and don't flush down, but that's what they do. They flush down so that the big banks and hedge funds can come and buy some more, right? They wait for markets to come down into these regions like this, and then this is where they like to be buyers, and that's why when they get some good news on the earnings, which is what I'm betting happened today, this is probably an earnings play. I don't know. I didn't double check. We should go do that right now. So how do we do that? Well, the easiest way, you can go look at the earnings websites. There's a bunch of websites that do it, but I like SuperGrok. We just say, what caused Meta to go to the moon today? Did they have positive earnings? So that's what I like to do. I like to use our new tools that we have available to us now. Meta platform stock surged significantly today, rising around 7 to 9% and trading with prices of 716 in the range. This moon move followed by the company's fourth quarter earnings. There you go. Reported release after market closed January 28th. Yes, they had positive earnings. In fact, they strong ones that beat Wall Street expectations. Earnings per share. The big driver of the jump wasn't just the beat, but the forward guidance and significant meta-heavy AI investment are paying off in the core business. All right, let's ask about Microsoft. Why Microsoft flushed like a toilet? All right, why did Microsoft flush like a toilet? Then it's going to probably be bad earnings. Microsoft stock tanked hard today. The trigger was company's fiscal earnings release after close of 28. While the numbers beat expectations on the surface, revenue year over year beat estimates. Oh, that's weird. Adjusted earnings per share. Microsoft Cloud Azure crossed 50 billion quarterly for the first time. Strong AI demand noted, with backlog surging to 625, doubled recently, partly thanks to OpenAI commitment. Investors ignored the beat and hammered the stock over forward-looking concerns, especially the AI investment compared to the massive spending. Azure cloud growth slowed. It grew 39% over a year. So they had good earnings. They just everything flushed anyway. That's weird. Oftentimes, I think that kind of thing happens because big firms dump it in an attempt to buy it lower. And you're going to see this will probably be right down in here. This will probably be a low, and it'll turn and start to go back up again. This might be you'll look at that in 2 months, and you'll say, why in the heck didn't I buy it at 61.8? Well, because they had bad earnings. Let's go look at their earnings. So we're going to pull up this little tool. It's called FinViz. We're going to come over here. Instantly spot drawdowns, dips, insider moves, and breakout things with across maps and screens. What's this? This is a new feature. New look of maps from 52-week highs and lows. Maps. We already got maps. Insider trading maps. Insider's transaction map. Huh. That must be something new. We'll have to go look at that. Market cap map. I got all kinds of new maps here. Themes maps. Wow. This is all new stuff. Screener. That's not new. Huh. All right. So we got some new tools with this little ding-dong tool here. This little ding-dong tool. All right. Let's come in here and look at, we wanted to look at Microsoft, MSFT, right? MSFT, Microsoft shares sink 12% after earnings. Whew, down it goes. Let's go look at their earnings. Did they post them? They did. Get out of the way. It's a dumb program. So it's all green, all green, all green, 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 and it dumped. I think we buy. This is a good time. Well, see, they're not pulling their shares back. They're making money, and their earnings per share went up. Sales 305 billion. Oh, man, why? There is no reason this stock should have gone down. I think this is a buy. Buy that baby right there. We'll wait and see, but I bet you that'd be a good place to turn Heiken-Ash out. It's still down there. It's making lower lows. Let's go down to a smaller time frame. Let's go down to a 2-minute chart and see what's going on down here. What the heck? What the heck? All right, this market Let's turn on Fibonacci. Still flushing. Boy, look at all this stuff going on here. 4 p.m. yesterday. That's the manipulation, market manipulation right there. That's some crazy stuff happening. Look at that. And then we came into the 4 p.m., 5 p.m., 4:35. This thing flushed last night, and then 5 a.m. it flushed. That was your key right there. Somebody knew something. Remember, we always talk about the 5 o'clock opening bell, which is the pre-market session. That's your giveaway of what's going to happen for the rest of the day. You look at 5 o'clock on the stock, and if that 5 o'clock is down, that thing's going to do this. If this thing is green and it's going up, it's going to move and it's going to go up. Does it work every time? Not every time, just almost every time. It's a pretty good little indicator. This is the opening at 5 o'clock in the morning. It's the pre-market session. It's when the pros start to trade for the most part. There's some, kids that trade there too, but not very often. Not very many retail traders trade this. So this is usually the pros that are starting right here at 5 o'clock. And if they flush it out, they know something. Something they know. They know something's happening right there. And sure enough, this is the real market open right there, 7:30. That's when the market opened, and down that baby went. These guys told you right there. Keep that in mind. In fact, let's go look at Meta and see. Let's go down to a 2-minute chart on Meta. See that? There's the 5 o'clock bell right there. And that all took off right there at 5 o'clock in the morning. Big green bar. What's Meta going to do? It's going to go straight up. It's flushing back now. Look at this. It's coming back against that big run. Wow. That's crazy. So that was the initial run. Oh, it's back here. 2 o'clock p.m. yesterday after the market closed. It's the big run. And then this was the morning. Now it's pulling back against that whole bar. Down, it's flushing. That's crazy. Look at that. What the heck? Well, that's pulling off that big peak right up in there, isn't it? Right there. So now it's clear down here. Now it's clear down here. What the heck is going on, folks and people and dogs and cats? Put your Fibonacci ruler in here on Meta, and you can see how it played down through this delta cone probability. What's the delta cone probability, Lan? I'm new here. What the heck is that? We measure it. We count and we measure. Count, measure, set up, trigger, and follow through. Count, measure, set up, trigger, and follow through. This is how we trade. What are we counting? We're counting basically how high it goes. And then we're also counting how much further it comes back down against the previous run up. And that's called measuring. So now we're going to measure. So we're going to measure how far it goes up. Usually we get 3 drives. There's 3 drives. One drive, 2 drives, 3 drives. We get 3 of those. And it's not always that pretty, but sometimes it's prettier. That's not the prettiest because we got one massive big drive and then a little drive and then a pullback and another little drive. Then we get a little topping formation. Remember we talked about those, A, B, C top formation. Then we get 2 drives down off the top. Drive 1, counter trend, drive 2. I mean, this is classic right out of the book. Page 63 in the book, somewhere around there, right out of the book. And then it came down, it touched 61.8 like a train on rails. And then when it started to rally, it came back, made a higher low, just like that, higher than this low. We're no longer making lower highs and lower lows. We're now making higher highs and higher lows. That thing came down with our natural mathematical model trend line, which is that little blue light right in there. And boom, that thing took off like a rocket ship, just like out of the manual. I mean, you couldn't have drawn, I could print this and put it in the manual as an example. The manual, Lan, what manual? I don't have a manual. I'm from Kentucky. I'm not in your university class. Help me out here. All right, the Fibonacci manual. Here it is. You can get the electronic version over at pitnews.com in the store for half the price that you can. I'm losing my voice. Hold on a second. you can get the electronic version over at pitnews.com for half the price that you can get the paper version out on Amazon. You want it on Amazon, it's just search Lan H. Turner and it'll pop up. Here's what the cover looks like, so you can see it when you know you got the right one. There it is. That's what the cover looks like. Let's make it so you can see it all at once. Minus. So that's the book out on Amazon. And when I talk about count, measure, setup, trigger, and follow through, that's what this book is all about. All right, teaches you all of this stuff. So we talk about the ABC patterns, higher highs and higher lows, lower highs and lower lows. We talk about how we measure them, how we count them, and how they work out in the system. So you can see all the little examples in here: A1, B1, C1, A2, 3, A2, B2, 3, C2, 3. All kinds of examples. So this is all teaching you how all this stuff works. It's like it's over 200 page full color book. All right, out on Amazon. And this is the digital version of it that you can get over on. It shows you how see how it works. 3 drives, drive 1, drive 2, drive 3. And then we get the pullback. Here's another example. Drive 1, drive 2, drive 3, get the pullback. Here's another example. Drive 1, drive 2, drive 3. That looks like Microsoft, looks like Meta, doesn't it? In fact, that's SPY. That's the S&P 500 did that. Here's another one. Drive 1, drive 2, and then this pulled back. Had a little tiny one here, but you're drive 1, drive 2, and then it flushed. Drive 1, drive 2, drive 3, and then we get the ABC flush off the back. See, it's all in here. It's all lined out. This is the bull side. This is the bear side. Then we talk about Fibonacci. We talk about how you measure it. Okay, I'm going to take you over and I'm going to show you the supplemental. Maybe I won't. Where'd it go? Here, let me see. Maybe it's the supplemental. Here, I'll get it. I know where it is. We're going to go like this. We're going to go, I think it's lanturner.com/ no, it's not. I think it's pitnews.com/ slides. Nope, that's not it. .pdf, that's it. Okay, there's the supplemental to the book. And so this is the decision point trading insights. And so then we come down here and load this baby up, and I'm going to show you the delta cone of probability. We're going to slide all the way to the bottom. And it's right here. Right here somewhere. And I'm going to show you the delta cone of probability right there. Okay, this is probably one of the most important slides I can show you, because markets have a tendency. This is also, I call it the delta cone of probability. It's not really the delta cone of probability. That's just the name I gave to it. And so, oh, Jared's making sure that people understand that that's 5 a.m. Mountain Time. Yes, that's true. It's 5 a.m. Mountain Time because my software is Mountain. So if you're going to make adjustments for that, so correct. All right. So delta cone of probability. All right. The real name for it is if you've taken classes on statistics, this is the real name. It's called the 68, 95, 99.7 empirical data distribution rule. All right. But that's hard to say. Every time I want to tell you about the delta cone of probability, I'd have to say it's the 68, 95, 99.7 empirical data distribution rule. That's hard to say. So I renamed it to delta cone of probability because it really comes from options where we have a delta cone. All right. So it's the options delta cone. So I just call it the delta cone of probability. But what it tells us, that empirical data distribution rule tells us that approximately 68.2% of the time, markets stay within a standard deviation, one standard deviation of the current price. So you see the markets coming along in my little example here. It will 68.2% of the time stay inside that little box, one standard deviation. 95.4% of the time, it'll stay within 2 standard deviations. And nearly 99.7% of the time, it'll go out 3 standard deviations. It only goes out to that 3rd standard deviation 99.7%, less than 1% of the time. So it doesn't really go out there and very often based on mathematical models and rules. So if we come down here, you can say that the mean reversion suggests that asset prices have historically eventually returned to the mean or average price levels. And that's the most key point here. If that market does move and go way out here into the second or third standard deviation, which is what we're talking about, 3-drive pattern, right? You get the first drive. Okay, we left the first standard deviation. You get a second drive, it's gone out to the second standard deviation. You get a third drive, it's gone out to the third standard deviation. And when that happens, the market eventually returns to the standard mean, back to the first standard deviation. All right. So we oftentimes look for it to come right back down to at least the top of that standard deviation, which is 38.2 on the retracement scale. If it comes back to the center, that's 50%. If it comes all the way back down here, that's 61.8%. So that's how far that comes. So that's the Fibonacci rule. Now, there's a couple other tools that'll measure this for you. Some people use Bollinger Bands. Some people use the RAF tool. I like the RAF tool. I'm not so big into Bollinger Bands. I'm more into the Fibonacci stuff. So Fibonacci measures it a lot better for us, and that's the one I like to use. And RAF is a little bit kind of a different tool, kind of little Fibonacci style. So that's what we're measuring. We're measuring that. And I took this bell curve, which usually sits this way, right? And I turned it sideways. Why? Because our charts, they go this way. They don't go this way. So stock charts go sideways. So we know if the market's going up or down through that standard deviation, through that bell curve. So our entry, so this is the application in trading. Entry. Traders look for a deviation from the mean, 1 standard deviation to 2 standard deviations as a potential entry point for mean reversion trades. Risk management, understanding reversion zones helps in setting stop losses and profit targets. Options traders use mean reversion to write calls and or puts to center at the center of the 1 standard deviation range along the VWAP line, taking advantage of statistical averages that price stays within the range approximately 68.2% of the time. So this is where you anticipate the market's going to stay most of the time. But when it leaves it and comes back, well, generally it wants to come back. So what we do is we measure it. We measure it from the top to the bottom. So we take a big run like that, and then we measure it using a Fibonacci ruler, which is just a ruler that has 38, 50, and 61.8 on it. And so we measure from the low to the high. So this is leaving the standard deviation. This is the first leave of the standard deviation. This is the second. We're up into the third standard deviation. So the chances of it going up into a 4 standard deviation is really low. Doesn't mean it can't. Certainly can. Markets can do anything they want. But mathematically and statistically and probability speaking, that's not going to happen. Therefore, we don't buy into rising markets. We don't buy into markets that are way up here at the edge of the third standard deviation. That's a bad place to be buying it because the odds, right? The odds of that thing going any higher are what? 99.7% against you. So it's like a 0.3% chance that market's going to continue higher once it's gone to the edge of the third drive. So you go third drive, doesn't mean it can't go higher. Certainly can. I can show you dozens of examples where it has. But for you and me as small speculators, we don't want to take those chances. Don't do it. All right. You're bucking the odds. And your pockets aren't deep enough to buck those odds. Maybe if you were BlackRock, you could buck those odds. But you ain't BlackRock. All right. You're little Land Turner from Fillmore, Utah. You don't have pockets like BlackRock. So why would you go and start buying a market that has the odds 0.3% of going higher at this level right here? But yet retail traders do it all the time. They don't know the odds, right? You're playing the odds and the statistics. So we're up here at the top of a third drive, and now we're looking for it to come down, and that's exactly what Meta did. Doesn't matter how strong Meta is. The odds are that thing's not going to go up any higher. And it came right down, nice little ABC top pattern, and then 2 more drives after that, right down into the 61.8 at the bottom of the delta cone of probability, right there. And when I saw that, I was like, well, it's starting to go back up. And then if it makes a lower high, gives us an ABCD pattern, right? A, B, C, D. Then we're going to anticipate that the market's going to rally from there, and it's going to go up. And so when it did, that's where I bought in, and that's why I bought. So you're like, well, Lan, why did you do that? Why did you know to buy there? Well, I didn't know it was going to do that. I just knew that we were getting higher highs and higher lows off of a retracement back into the delta cone of probability, and I knew that the standard deviation was. I knew what the standard deviation was, and we were at the bottom of this previous standard deviation at 61.8, which is exactly this point right here, 1 standard deviation, and it was here, and it came down, and it touched that 1 standard deviation. When it comes all the way to the top of this third standard deviation and comes all the way down back to the bottom of the lower first standard deviation, Well, that gives me confidence that I can put some money in there in anticipation of it rising back up into the 1 standard deviation and maybe even back up into 2 and 3 again. I don't know where it's going to go, but the odds of it going any lower started to get further and further. There's a 94.4% chance that it wasn't going to go any lower. Doesn't mean it can't go lower. It certainly can. If it came down here into the 2nd standard deviation, well, I'd have bought some more. All right, because the chance of it staying down there and going to the 3rd standard deviations gets pretty low, 0.3%. So if we come back and look at the chart and say, well, how do we measure that? Let's come in here and get rid of all the drawings, all these little everything except for, well, let's just erase everything. We'll put that Fibonacci ruler back in. And then we go all the way to the top. We come over here. And now we come in here, and this is where that standard deviation is. See that? Look at that. It's just like a train on rails. Came down and broke it here, went down and touched it just like it knew it was there. Of course it knew it was there. You think I learned this stuff? You think I made this stuff up? No. I learned all this stuff at the Chicago Board of Trade. You know where that is? That's the Temple of Finance back in Chicago. That's where I learned all this stuff. That's how the big banks and the hedge funds program their computers. That's why most of this stuff does this, is because the computers are programmed to do it. That's why I was saying the other day in class, as the markets become more and more predictable, the more that computers are doing all the trading. The more computers that are trading, the better for us, because now the computers are programmed to go at certain places and locations and standard deviations. They've got all that math put into them, into the programs. They're not random. They're not just out here willy-nilly buying things. Everything's based on statistics and probabilities. It's all one great big math model. And because those great big guys have had programmed all this stuff into their big computers to trade it like that, well, the market performs like that. And the more that we get computers that trade it, the more the market's going to perform like that. It's catch-22, right? Oh, it's almost self-fulfilling prophecy. Oh, AI is trading the computers. Oh, we got AI trading now. No one's ever going to be able to trade again. That's the biggest crock of shit I ever heard. You know how long we've had computers trading the market? Since I was a little boy in diapers. Computers have been trading the markets for forever. All right. Just because AI comes along, it's just another way of having something trade the market for you. It's just another computer trading the market against another million computers that have already been trading the markets for forever. The more computers that trade the market, the more it's going to be predictable, because they do these formulas, they do these probabilities, they understand these mathematical models. And so when the markets get to these certain high level mathematical models, they start to buy. So it becomes predictable, and it causes the market to do exactly what we expected or anticipated it to do. The only people who don't take advantage of this are people who don't know those models. That's why you're here in this class, because I'm going to teach them to you. All right. So this is why this works. Oh, you want to see that last model? Let's come down here. And what if the market goes back further down into this other standard deviations down here? We go down to 2 standard deviations or 3 standard deviations back against the mean. Well, we got that in the little ruler too. You just right click on it and you turn on the fib lines, and we turn on 78.6 right here. See, and that's the next standard deviation, 78.6. That's this number right here. That's the second standard deviation down right there. That's this one. Okay, so we turn that one on. Now, it doesn't go down there very often, only about 0.3% of the time. Let's just say 1% of the time it goes down there. Doesn't mean it can't, certainly can. The big computers mostly don't drive it down there unless there's a lot of really bad fundamental news, and then when they turn off the computers that buy it 61.8. But normally what happens is this has got to have some really bad fundamental news that drives the market down further, and then retail traders are usually the ones that push it down. And then that would be a good place to add on some more. So if you want to come, it's called catching a falling knife. You can say, well, it crossed the 38.2. I'm going to put some money in. Okay, well, it's on its way down. That's called catching a falling knife. And then it come down, it stopped right at 61.8. A lot of people just start throwing money in right there. Oh, it hit the number. It's a good place to put your money in. Chance of it going all the way down here is pretty low, right? So it started to bounce and come up here. So if we come and look at Amazon or Microsoft actually had good earnings. Why did it come down here? Probably, I don't know. I can only guess. Retail traders getting scared. I don't know. Retail traders would normally go long on that. This has got to be some sort of a computerized system. Somebody made a decision. Somebody dumped that. But technically speaking, fundamentally speaking, this thing is at the bottom. Now, what's the chance it go lower? Well, with something like that, it could certainly go lower, or it could at least stay down here. No, we don't know. We're gonna have to wait and see. But usually when you get those types of bars, um, you get a quick rebound. So we'll see. And it came right down to 61.8, and it's still dropping. So this is the delta cone of probability, but you can see the thing went almost like a train on rails right to that point, and then that flush right there. I think if I had to guess, I would say that there's some insider thing happening here. This is not normal, and especially on a positive earnings. I think some big firm, BlackRock, State Street, Vanguard, somebody did something. Somebody flushed out. The only thing that drops, you and I, little small speculators from Fillmore, Utah, can't do that. All right, that's some huge, massive firm dumped out of that for some reason. All right. So this is our drive. Now we didn't get this. The little blue lights are generally what we count the 3 drive pattern, right? We get drive 1, and then we get a little ABC pattern. We get a drive 2, and then we get a little ABC pattern and a drive 3. And that's what takes us to the top of the 3 drive pattern, or up through the 3 cone probability, or the standard deviations. So when this one just went straight up. I mean, look at that thing. Holy cow. Microsoft just went straight up. It had one little break right there, and that was it. But then we got our little double top up in here, just like that. And then that's a key right there. That's a big double top. We're way up here to the top, key, and then down it went. Down 1, flush, down 2. And now we got this flush. This is bringing us down to 3. All right. Usually we get 2. So, but doesn't mean you can't go to 3. We can get 3 coming down too. That's just bearish when it gets 3 drives down. And we're going to probably combine all these. We're going to just say this is drive 1, this is a counter trend, and then this is drive 2. We'll see what happens at the drive 2. I don't think this would be a bad place to buy some shares. A little scary to put some in right now with the market flushing like that. But if you bought some at 61.8, like I said, in two months, you're going to look back and say, why didn't I buy right there? It was right at 61.8. And then it turned around and went to the moon. The reason we don't buy is because it's scary. It's like, why in the heck did that thing flush all at once? Now, if it was only coming down here slow, making a nice little slow run down here and start to roll across the bottom, well, that's a lot easier to put something in. But when it flushes like that, then you have to question, what somebody knows something I don't know. So we don't know. I don't know. Wouldn't be a bad place to buy some. Microsoft's a good company, but that's kind of crazy. So if we come in here to our Fibonacci ruler and turn on the next line, 78.6, this would be down here on this next second standard deviation right here. This line here. See this line? That would be this line right here, 78.6. And it could come down there. It could definitely come down there. We'd want to be buyers, right? We'd want to be buyers down in this region. And it's not like, we're not building a commercial building here. These numbers are kind of, I always call it the area, right? The area of resistance, the area of support, because it's down in this region somewhere. They're computerized, so oftentimes you'll see them come down and hit these numbers just like trains on rails. But it's just kind of in this general region, because you got retail traders who don't know these numbers, and then they start messing it up so it doesn't come directly to the numbers that the computers do, right? So this is why I say the area, because you got to take into consideration retail traders. But this is where we want to be buyers on Microsoft. I mean, this is definitely a buying zone. Just I'm not sure if I want to buy it today, but tomorrow this thing might be, it might open up way up here, if you don't put any in right now. So a fun place to put some in might be on what is, well, we're going to talk about that next week. I'm not going to talk about that this week, because this class is meant to talk about some ETFs. So the ETF that I'm pointing out now, last night in class, we talked about some of my favorite ETFs for pairs trading. And pairs trading is when you take, you pair up one set of stocks with another, or ETFs in this case. You can do individual stocks, and we're going to talk about that next week. But for now, we're going to come in here and we're going to do a little pairs trading. But I wanted to talk about these markets that came in here so crazy, right? Should we put the delta cone of probability on this one and see what Amazon is saying? All the way from bottom to top. See, this thing already came back down into the let's go to this one here. See, it didn't come back down. See, because at the time, that's what this one did. See? So it went up through the delta cone of probability, had 3 drives. Drive 1, drive 2, drive 3. Probability, or what are we calling it? We're calling it the standard deviations. So we're going to go up through standard deviation 1, standard deviation 2, standard deviation 3. Once we get up to the top of standard deviation 3, we're just going to expect a pullback. Now this one, strong market, Amazon. It didn't drop all the way back down into the 1 standard deviation down in here. It came down close, came down right in here, and then it started to bounce and go back up again. And then it came down and it tried to make a little double top up in here, right? So with this one, we were anticipating that, well, here's your A, B, C pattern. So we're going to expect it to come back down, and off of this double top, it came right back down to the Fibonacci number 130.9, which is the golden ratio. It didn't come back down into this 1 standard deviation. It just stayed right up in here. But that's kind of right where you anticipate, because this is the low. This is where it came down to. We'll stretch that over. It just kind of came a little slower this time. So, but that's the standard deviation right there. And you put those right on those little markers. Right down here, 100%, right down in here, to almost touch 130.9. That's a little bit lower, closer to 38.2, isn't it? And then it turned, started to go back up again. That's 2 drives. 2 drives down. Drive 1, counter trend, drive 2. This little blue light system from the bulls and bears is what's telling me that. And so then this market just takes off, went to the moon. Now it broke, tried to break above, right up in here. So it broke above that previous high, but it couldn't maintain it. Came right back down into that little channel. So now we're just kind of in a little channel going sideways like this. And it's trying to break out the top of that little channel again. So the market pressure right now is to pull it back down, but it's trying to go up. So you're making higher lows. Making higher lows. So there's a low. There's a low. There's a low. But they're all higher lows. This low is higher than this low. This low is higher than this low. This low is higher than this low. So we're making a nice little uptrend off of these lows in here. And we're making higher highs. So we got this high, but then it came down with this little ABC. But now this is high. And then we got a higher high here. And we got a lower high here. So this has ended up in what we call a head and shoulders formation. So why we look at this and why we look at all these patterns is because this is what the computers do. Computers don't, they're not smart. They don't go out and look at fundamentals. I mean, they do to some degree, right? Because you have human intervention. But you also have just mathematical models. And these computers just trade off of mathematical models. That's all they do. Mathematical models and probabilities. And they put markets in there and they buy low and they sell high. That's how they do it. It's all programmed in. Now, there's some intervention. Computers, humans go in. They don't actually sit here and click the mouse like you and I do to buy. They just turn the system on that they want to have. So they have you go into their computers and they have a row of things that they can choose from, right? So like, oh, we're trading Amazon. I want it to run this system, and it's going to run it for the next. Well, it's going to run it until I turn it off, right? And then I'm going to run this system. So they can decide. They can have some decision. But overall, it's one big system that's running and trading and managing their systems, managing their money. So they run like computer systems that manage the money, but they're just doing a lot of dollar cost averaging on the way down. And then they recognize when markets get up into these high probability or low probability locations, and then they start to liquidate their positions and take them off as markets rise. So it's the retail traders that screw everything up. But they're taking your money. That's the whole idea. They've got all the money in the world. The only money they don't have is what's in your pocket, and they want that too. So that's what these systems are designed about. They're all based around retail traders and trying to take your money. So this is where we're anticipating this one here. We got a lower high. So that's coming down. Could it break up and make a new higher high? It could. But we're coming into what we call a wedge pattern or triangle formation. So we got lower highs and we got higher lows. So that's coming into what, it's like an explosive zone in here. What happens is you get so much pressure, markets coming in, smaller little area, and eventually it breaks out and goes one way or the other. And so we'll see what happens in here, but you can see this little triangle formation. So if we come back over to the manual, you're going to see that we got all those little patterns are in here. And here's where you get all these little patterns. See, we talk about all the little patterns, how all this stuff works in the manual. So you've got it all written down for you. So this is where all your little ABC patterns, your top formations that I'm sitting there talking, all these little triangles and wedge patterns. See how I drew that little wedge pattern over here, right here? That little wedge pattern, it's a process of higher lows and lower highs. That's what causes a wedge pattern. And you can bring this one back even farther because it goes back all the way to here. So you have this nice big wedge pattern. You can pull this one back a little bit further too, all the way to here. See that? Now it's a big old wedge pattern in there. And there's where these wedge patterns generally come, that generally show up. And how do you trade them? Well, we got them all in here written down for you. So I see all these different wedge patterns. Depends on how they show up in the trend, where they generally show up in the trend. So see that one? This is the one we're getting right here. It kind of looks a lot like that one, doesn't it? So what would happen if it was like that? Well, it's actually coming down already. So it went up. We'd probably get another little down like that, kind of like this. It kind of looks more like, well, kind of like, well, it's coming down. So it's this one here. That's exactly it right there, the rising wedge. See that? It's coming down off the top, and then it's rising up, probably fall again. It's coming down off the top, it's rising up, it'll probably fall again. Isn't that exactly what we're looking at? That little model right there. So you come and find it, you come find out what's, look in these little patterns that you got in the book. Say, oh, that's where it's at right now. It looks just like that. It's making higher highs and lower highs. It's coming down in a wedge pattern, and it looks bearish to me. Of course, we got this. This is up. You know, it could pop out the top. This could be, but this big down one, and then lower high. Since this is lower than this one, and this is lower than this one, you know, it could go either way. Could go either way. When it pops out of this triangle formation, it'll probably come down in here and use this as an area of support. Sometimes, like a good running back of a, football team, sometimes it'll fake one way and turn and go the other way. Or it'll come down like this and do that same thing. It'll fake this way and then flush out down this way. Those are called bull traps and bear traps. You have to be mindful of that too, because they like to play those games. This whole market's controlled by the big banks and hedge funds that run these systems. And they're just trying to take your money. That's what they're doing. Their whole game is to take your money. And so they run these patterns and they run these systems to try and get you to buy, try to get you to sell at different locations. Now, the main game, the primary game, is this one here, right? This is the primary game right here. So this is the primary game. This is your roadmap. This is what the big hedge funds and banks primarily, this is the core process of what they're doing. And you can see it right in that market right there. Now, I drew this a long time ago. I didn't draw it because Amazon did this. So you can see it's right straight out of the manual. So this is the accumulation stage down in here. That's why it's red and yellow. This is where lots of buying is going on down here. Remember, we're going to buy low, sell high. So this is where lots of buying is going on. And then as the market rallies up through these drives, see drive 1, drive 2, drive 3. That's this, drive 1, drive 2, drive 3. And we get up here to the top. And this is why I thought we were going to get a bigger blow off right here, but it didn't. It just came down off this little one right here. So we got the little double top up in here, just kind of like this one here. We call it the spring. See where it fakes one way, fakes, makes you think it's going to go that way, and then it flushes the other way. And then it comes down. It went into this little zone here. I thought we were going to get one more little drop down in here, back down into the Fibonacci sweet spot, or into the delta cone, the one cone of probability, right? Back into here. But that's not what happened, right? And then came in, and then I thought it was going to come down here, and it didn't. It was too strong. This was Amazon, so it took off and went up again right from there. And then this little piece right here that I thought was going to be down one more just took off and went from there. But I think that because it didn't come down here far enough, that's why we're getting this little drift in here. This little drift is starting to be a little higher. This is the accumulation stage. The pressure is for this, the model says that thing should go higher. If that's the model, if it came back and this is the reproduction of this right here, if this is where they're at, that's why we get the pop out. It should take off and go farther. But we got some other fundamental driving factors that are taking this into consideration. So, all right, that's that one. Let's go look at the SPY. I want to look at SPY because that's one of the ones we talked about last night in class. And then we had the pair, which was TSPY, right? So that's the pair. So let's come in here and let's create a new, let's get rid of everything. Let's go boom, 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 boom. Just kill all these. I'm just going to take all these off the table. And we're going to pull up our pairs trading. We're going to go SPY and TSPY. All right. And we're going to put those side by side or over the top feature. Let's get rid of this. We don't need that. So this is what this market looks like. Now, TSPY is the one that gives us dividends, right? So let's go do a little dividend math. We're going to come in here, and the dividend math is going to come off of this little tool right here, and we're going to come in and we're going to put TSPY. Now you can see right here, TSPY, that it gives you dividends every month. See these little D's down here? That shows you the dividends. So if you click on it, it gives you 30 cents, amounts 30 cents. And if you look back in time, it's been pretty consistent. 30 cents, 30 cents, 30 cents, 30 cents, 30 cents. Now we're back here a little bit further. It's 29 cents, 29 cents, 28 cents. But the share price is lower. All right, it's 30 cents right here. Now remember, the way you get paid dividends is that they give you this dividend, 30 cents right here on every share that you own. Doesn't matter what you paid for the share. The only thing that matters is how many shares you have. So the name of the game is to accumulate as many shares as you possibly can to get more dividends, right? And the dividends, big enough amount of money, hopefully, that you can live off of it. That's going to be your paycheck. So we're going to come in here, and this is like buying the house, like we talked last night, is buying the shares. How many shares? How many houses? And then this is the rent. So we want as many houses as we can get. So if you think about each share as a house, you want as many houses as you can get, because each house gets a little bit of rent. They get 30 cents on each share. So $25, 30 cents. So if we take our little calculator, let's do it manually first, and then we'll go have the computer do it for us. So I'll show you how to do it manually first. So the first thing you do is you take your little calculator, and we come in here and we say, well, TSPY, $25 a share. Let's say I'm going to put $10,000 in there. So we're going to clear this. We're going to put 10,000. So we put 10,000 in, because we have $10,000. That's our investment. How many shares can we buy with 10,000? So we just take 10,000 divided by 25.46, divided by 25.46. We can get 392 shares. So if we have 392 shares and it pays dividends of 30 cents per share, all we do is just take how many shares we have, multiply it by 30.2 times 30.2. That's how much they're going to drop into your account. And I did 30,000. That would have been nice. 25. So I forgot now. 10,000, 1, 2, 3, divided by 25.47 equals 392 shares times 0.30. Not 30,000, not 30, 0.30. So it ends up being $117 per share. Okay. So $117 per month on $10,000 $117 on $10,000. That's how much you're making on dividends with TSPY. So you can back into that, and you can say, well, if I have TSPY and I want to live off the dividends, then how many at 117 for $10,000? How many $10,000 would I need? You need $100,000 to make $1,000 a month, right? That's basically how that turns out. So if you need $1,000 a month to be a supplement to your income, you'd need $100,000 in TSPY. Now, we're going to get into some that have much higher numbers than that, and we're going to show you how to manage them. So as you keep coming to class, we're going to talk about dividends that go way higher than that. All right. But we have to learn a whole new strategy. We have to learn a whole new way of thinking. And so that's what I've been bringing you through in these classes at the university, is a different way of thinking. But I have to teach you this basic structure first. Now you've got this down. Now we can take you into a whole new world and flip everything upside down. All right. Break everything we just taught you. So now we're going to come in here and go to its companion. What's its companion? This is TSPY. This is the dividend version. So we're going to go into the SPY. So the SPY is its companion. So remember, all dividend stocks, you want to try and find their companion. And if it's obvious, like this one, SPY and TSPY, pretty obvious. Okay. So we got a companion trade. So what we're going to do now is we want to decide how much money we need, how much cash we got. I need $1,000 a month to supplement my income. If I have more than that, I don't need it. I don't need more than $1,000 a month. Hypothetically, all right. This is what you're saying to yourself when you do this. You're saying, but I've got 200,000. Okay, well, if you have 200,000 and you only need 1,000, well, you don't want to pull out more out of the stock market than what you need, because if you do, you're going to have to pay taxes on it. Okay, so a dividend, if you think about a dividend, we have what we call taxable events. So every time you buy into a market and it rises in price and then you sell it, well, you're going to have to pay taxes unless it's in a protected account. Now, obviously, if you're over in something like an IRA or a 401k or something, you're doing the trading, there's no taxable event. But for people who are doing this for income, we're generally doing it out here in a standard account. It's not a tax-free account. You're going to, every time you make money, you have to pay taxes on it. So a lot of people like to do the buy and hold, and they won't ever sell because they're worried they're going to have to pay taxes on it. I will tell you that that's oftentimes not a good reason to not sell your shares. Because I know, historically speaking, and we're going to go, let's look historically speaking on the SPY. We're going to go down here to a monthly chart. Oh, not going to go to monthly. We're going to go to weekly. Oh, that's the wrong one anyway. We're going to go to monthly chart. Okay, so overall, this is the S&P 500. So historically speaking, over time, this market's just gone up, 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 up and away, right? It just keeps going up. It's basically the U.S. economy. Okay, so when we talk about growth of the U.S. economy, so we're talking about basically the growth of the stock market, because the S&P 500 is the 500 biggest companies in the U.S. So people will often say, oh, the stock market is not a representation of the economy. That's a bullshit line. Whoever's telling you that is selling you something. That's exactly what the stock market is. That's exactly what the S&P 500 is. It's a measuring gauge of how well the U.S. economy is doing. Okay, it's the top 500 best companies in the U.S. What better measuring gauge do you have? Of course, it's exactly what it is. So when we have the GDP, what we call the gross domestic product, and we say, well, the GDP is growing at a rate of 5%. Well, this is what you're talking about. You're talking about the S&P 500, or the 500 biggest companies. Now, of course, there's a lot more companies than just the 500 biggest, but this is a pretty damn good gauge if you ask me. All right. So when they say, oh, the stock market isn't a representation of the it's a political ploy. It's the Republicans are in office and the market's doing well, so the Democrats will say, well, the stock market is not a representation, and they want to take that away from you. Or vice versa. The Democrats are in and the market's going up, and the Republicans will say, oh, the stock market is not a representation of the U.S. economy. They're not, and they're trying to take that away from the prevailing political party. It's a political statement to say that. So anybody who tells you that is trying to sell you something, probably a political position. So it's exactly what it is. That is exactly what it is. It is a representation of the U.S. economy. And if you believe that the U.S. economy is still going to continue to grow, or if it's going to contract, well, that's what causes the stock market to grow or contract. So we've had moments of contraction, right? This was a nasty contraction right here. We had a little bit of a nasty contraction here. We had COVID right here. I think that's COVID right there. Or was this COVID? COVID actually ends up, when was COVID? It was 2021, 2020. COVID was tiny in comparison to some of these things that have happened. I mean, right here, everybody freaked out about COVID, right? How COVID ruined the whole market. Well, that was COVID. And then this came in. Nobody even said a word about that one. Nobody even said a word. You never heard about this big move here, right? This was all the Fed playing politics. This was all a political run right here. This all was political. And so then it ran back up in here, and now we're way up in here. And the economy's doing really well. It's taken off, going crazy, right? So 2024 was here, 2025 is here. And so this is the recovery of this big move here. This is the recovery right here of Corona. I think that's COVID right there. And so that's how the history of this market has always worked. So when you come in here and you say, well, I'm not going to ever sell out because the market just always goes up. Yeah, but problem is, if you look, we have these little events that occur on a pretty regular basis. This is remember, each one of these price bars represents 1 month. So you don't want to really sell out, but there's nothing wrong with playing the market a little bit, trying to play a little market game in here, because this time frame is 21 all the way to 24. So that's from this high right here. And the point I'm trying to make is that by the time it recovers, that was almost 5 years, right? Through there, from here, December 21. So let's just say January 22 until March of 24. So a little over almost 2.5 years to recover that right there. Okay, so that was a 2.5 year recovery. And so it sat there for 2.5 years going down. For a whole year, it flushed out. You think about your emotional state on something like that. When a market gets up like that, sometimes it goes down for a long time. And the emotional state of that can really be messing with your mind. I'm not saying that that the market's not, we should trust that the U.S. economy is going to continue to grow. It's doing well right now. We got good, I believe we got good leadership. I think that we got a bright outlook we do have some problems though, don't we? We have big debt. The U.S. dollar is being manipulated by some of the big countries. So there's some things that can drag on the government, on the market. But nonetheless, this is just the U.S. government, and there's really no better place to put your money. A lot of people are saying, well, I'm going to go into international funds. Why? Why would you go into international funds when you got a market that does this? I mean, there's no other country in the world that's got an S&P 500 that looks like this. It's unbelievable. All right. So that's why I say this is a good one to start with. This is the first one we talked about last night. Now, we are reaching up into a pretty high zone where there might be a little pullback. All right. There might be a little flushback, a couple months. February is generally a good pullback month. We'll see. I don't know. But if you look at the daily chart, kind of feels like maybe we're getting up in here. We might get a little pullback. Might take it 3, 4, 5, 6 months, right? To come down and turn around, drop back down. I don't know. But it's kind of feeling a little toppy up in here. Not because the economy's doing bad, just because that's what markets do. They have a tendency to flush back a little bit so that we can have an opportunity to buy low again. Because remember, all the big computers, and then right at high. But so we're going to roll in and out. We can roll in and out of these two markets. That's the whole point, being able to roll in and out of them. This one provides an income. This one is your growth. Okay. So if you got $200,000 and you only need $100,000 and you only need $1,000 a month, if you put $200,000 in TSPY, you're going to be getting an extra $1,000 that you don't need. And the point that I'm making is that if you pull it out, it's a taxable event. You're going to have to pay taxes on it, even if you just go and put it right back into the market again. So that money that you're pulling out better be a sizable amount to make it worth taking it out. All right, getting that dividend so you can reinvest it or reinvest it somewhere else. The biggest problem is people take it out and put it right back into the same thing. Oh, I've got all my money in TSPY and I took 1,000 out. I'm just going to put 1,000 right back in. Well, why'd you do that? Why'd you take it out in the first place? Why'd you take the dividend? Because if you take the dividend, then you got to pay taxes on it. All right. And you got to figure taxes are about 22%. If you're in a 22-25% tax bracket, right, you're going to have to pay taxes 20. You're going to lose 25% of everything that you take out. So don't take it out if you don't need it. That's the point. We're going to leave it into we're going to leave it in SPY. And the only amount of money we're going to have in TSPY is the amount of money that we need to produce enough income for us to take the money out so we can have something to live on. Because it's basically the same market. This one just pays a dividend. This one doesn't. So this one takes it out and gives it to you. This one doesn't. And why wouldn't you just leave it all in this one then, Land? Why would you have two? Well, the reason is because this one takes it out as a dividend and this one leaves it in. And if you start taking it out of this one, let's say you just leave it in this one and you're like, well, I need some money. I'll take $1,000 out. Well, you have to sell some shares. And if you sell shares, then you don't have shares to grow, right? If you sell your shares off, it goes back to what we talked about, the Bill Gates problem. Bill Gates used to own the majority of Microsoft. Now he only owns 1%. Why? Because he wanted to take his profits out. So he sold his shares off. Now that he sold his shares off, he doesn't have any shares left to sell. Now what's he going to do? No more shares to sell. He's out of money. He's out of shares. So if we can avoid having that problem, that's the biggest problem that most of us fear when we go into retirement, right? I'm going to run out of money. I'm not going to have enough money to make it to the end of my life. Well, if you keep selling off your shares to live on, well, then now you're not going to have any money left because you're going to run out of shares. Hopefully you don't run out of shares before you die. But to solve that problem is you have some growth in SPY. And then as you have the growth, you can take it out of here. Yes, you're going to have to pay tax on it to roll it, but you put it in the TSPY and it's going to give you the growth in here without selling shares. So now in here, it's going to have the growth, plus it's going to take money out along the way. It's going to pay you along the way with some shares. And this is how you do it with the TSPY. Now there's other pairs that we're going to talk about. This is just one example, but once you understand the concept of pairs trading, you have growth and you have dividend, growth and yield. So now you can come in and you can look at the growth and the yield. We're going to go over to Portfolio Matrix, and I'm going to show you that one next step before I let you go for the day. We're going to go in here. Come on, Portfolio Matrix. How come that's not pulling up? Oh, we moved it over here. Land moved his windows. All right, so we're going to pull up Portfolio Matrix. Now, Portfolio Matrix, we're going to put in Portfolio Matrix TSPY. And TSPY, we're going to break it down. We're going to break TSPY in half. All right, this is the only program I know that does this. So you got to come in here, and this tells you what the dividends are and what the growth is. So you can see the gain or the growth was 2%. It only grew 2%. You're like, well, that's not good. Well, that's because they gave it to you in dividends. Okay, they gave you the yield 14%. So you ended up total 2 plus 14 gave you 16% annualized return. But you're going to leave the 2% in, right? You're not going to take that out, and you're going to take 14% out, and you're going to live off of it. So that's TSPY. And if we put $10,000 in, well, that 14% is about $1,000. Okay, $1,400 right there. So, but it's 16% total, but we're going to leave 2% in. So we're going to take 14% out. That's what it's done over this last run. Now, is it going to maintain that? Well, past performance is not necessarily indicative of future results, but it's the best we got, right? So we go off of past performance, and it is the S&P 500, and historically speaking, the thing's gone up over time. But it does have drawdowns and pullbacks, so we have to take that into consideration. So if we put SPY in here, you'll notice if we put SPY and we break it apart into its two components, gain and yield, well, the gain on it is 16% and the yield is 1.17. It's just almost the opposite of TSPY, right? So if we use these as a pairs trade, we can put money in each one. One is going to grow for us, and we're not going to be taking it out all the time and putting it back in, taking it out, put it in, take it out, put it in, because we don't need it. If we don't need it, don't take it out. Just leave it in SPY. If you need it, then you take it out, you pay your tax on it, put it into TSPY, and then it starts to pay in dividends. You start getting a bigger monthly increase. That's the name of the game. Now what we're going to do is in our next class, we're going to go through and we're going to start looking at other pairs. All right. We talked about, I think last night we talked about 3 pairs. We talked about SCHD, which is the dividend version, and SCHG, which is the growth version. So there's a pair that we can do this with. All right. We can invest in the SCHD and SCHG. And the other pair that we talked about was JEPI, JEPI, which is for the S&P 500, and JEPQ, which is for the QQQ. Now these are two dividend pairs. All right. So they're not the growth pair and the yield pair. They're 2 yield pairs. So we're going to go over and look at those real quick. Come into Portfolio Matrix, and we're going to put in QQQ. So you can see QQQ. So QQQ would be your growth pair, and then JEPQ would be your dividend pair if you're going to pair them. All right. So you've got QQQ, and we're going to pair it. And notice QQQ has growth of 20% and has yield almost nothing because it doesn't give you a dividend. So you put it into QQQ for growth, but then we're going to put it into, if we need income, if we want to take money out and go spend it, buy clothes and cars and food and things, and then we're going to go put it into JEPQ. This is our pair that brings you the dividends. So the dividends or the yield on this one is 11%. So you see the gain is only 3%. But that's because we're not trying to gain here. We're taking all the profits out. That's why there's no gain. So there's a high yield, and combined it's 14.44%. But we're not going to take this out either. That stays in the market. That 3% stays in the market. We're going to take the 11% out. That's the yield. We're going to go spend it. We're going to go buy things with it. We're going to pay our car payment with it. We're going to go pay our light bill with it. And then this one here, the gain is that's the total of the 2. So the JEPQ is the dividend version. The QQQ is the growth version. So now let's go do another one. This is the SPY. SPY, this is the growth version. We already talked about that one. You can see it broke apart here. It's got the gain is 16 and the yield is 1. So for a 17% on the SPY. But now we're going to do, instead of doing TSPY, we're going to do JEPI. JEPI. All right, JEPI is for the S&P 500. So now we got the growth, which is the S&P 500, and instead of TSPY, we're going to do JEPI. And JEPI is just a different one. Is it better or worse? Well, this month, it looks like TSPY did better, right? The gain on it, this one was only 0.43, and the yield was only 8.33 for a 7.89% return. So you're getting 8.33% on your dividends. So that's JEPI. And you look at JEPI and say, well, it looks like I would rather do TSPY than JEPI. It seems like TSPY was outperforming JEPI. But if you didn't have these tools to come and read this and look at these numbers, you wouldn't know that. So this is how you do it. That's what I'm here for. Show you how to do it. That's how you do it. All right. So then you put a bunch of money in here, you put a bunch of money in there, you have one that's growing, you'll have one that's paying you a deal. If you need more money, you pull some money out of this one, put it in this one, and it pays you more money. So that's the name of the game. We're going to find out, we're going to discover a whole bunch more of these pairs trades. And that's the name of the game. That's what our upcoming classes are. We're just going to continue to look at additional pairs. And then we're going to start to reverse and start thinking about things in a different way. We're going to start building a business around our pairs trading. And that's the concept of what we're going to be learning in our next classes. All right, guys, that's all I got for you today. If you guys haven't picked up Pit News Magazine, you're going to want to do that. I'd really highly recommend you go to Pit News Magazine and pick up Pit News Magazine. All you do is go to pitnews.com. And we got a new version that's coming out. This is the January issue. If you go and get it right now, you get the January issue and you'll get the February issue that's coming out in a couple of days. If you wait until February, then you don't get the January issue. You miss it. All right. So you got the January issue, and then this is where you subscribe. You just hit subscribe right here. And then if you want to subscribe to the podcast, which little Claire here, she's the one that runs the podcast. She hasn't done one in a few days. So I'll call her and find out when she's going to do another podcast. But you can get Pit News on Air. Click here and subscribe to that. And then we'll see what Claire's doing about getting a new podcast out. There's one that comes out in the magazine. So she is doing those. So every magazine has a podcast in it. So you'll get the January podcast and you'll get the February podcast. But once in a while, she posts new ones out on the Facebook, or not Facebook, on YouTube. So you can get those two, follow along with Claire. All right. She's also the assistant editor to the magazine. She helps me lay out the magazine. All right. And then there's the store. So you come to the store, and there's the Orion protocol. We talked about that in class last night. You can get it for $7 on Amazon. Yeah, everybody should have that. This is a really cool read. It's just a fun read. People don't read books anymore. But, for those of you who still do read books, there's still one or two of us around. This is a really fun read. You'll love it. Okay. It's a fun read. And then this is just a stock market options playbook. It's free. Just go out there and get it. There's lots of free stuff in here. And then this is the Ultimate Growth Steady Growth Guide. This is about what we taught you in class on SCHG and SCHD. So this is the same concept. You can use JEPI and JEPQ, and it talks about that. But it's free. You free download. All right. You get that, and then it's going to talk about this whole strategy that we just talked about today. It's going to show you how to do that. All right. So there's some fun stuff out here. This is where you get the digital book, and then this is where you get the paperback book. That's it. All right, guys. So go get your subscription to Pit News Magazine, and we'll see you. What's today? Today is Wednesday. Is today Wednesday? No, today's Thursday. Today is Thursday. We'll see you tomorrow night in class. All right. We got a special guest speaker flying in from Chicago just to speak to you guys. So we'll see you in class tomorrow night. And if you have any questions, please let me know, and we'll catch you later.
All right. That wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.